Are you ready for what's coming to the crypto market? A massive SEC rule change that barely anyone is talking about could kick the door wide open for a flood of new altcoin ETFs. While that's brewing, experts like Preston Pysh are looking at Bitcoin's path to $10 million, not just as a tech play, but as a necessary alternative to failing currencies. We're seeing institutions like Coinbase gear up for this new reality, and some analysts believe the old, brutal crypto winters might be a thing of the past. Meanwhile, traders are watching Ethereum for a potential short squeeze while new projects are mixing AI with real-world assets. From free trading bots to governments creating strategic Bitcoin reserves, everything is shifting. Do you know how to position your portfolio for this? In the latest video from Altcoin Daily, the discussion starts with a big picture view on Bitcoin from investor Preston Pysh. He explains that anyone planning to sell at $1 million doesn't really understand what's happening. If Bitcoin hits that number, he believes it's headed for $10 million and eventually $100 million, suggesting it's less about diminishing returns and more about its early position on the S-curve of adoption against failing fiat currencies. The points made in this video feel very connected to the current market narrative. The idea that Bitcoin's journey doesn't just stop at a certain price resonates with the ongoing inflation and currency debasement conversations. It's less of a tech investment and more of a financial life raft for some. What really ties it all together is the segment on tokenization. When Sergey Nazarov says we're at sub 1% of tokenization, it clicks with what we're seeing from giants like BlackRock launching tokenized funds like Boodle. This institutional push into tokenized real-world assets adds a lot of credibility to the idea that blockchain's biggest use case is still ahead of us. It makes the seemingly wild Bitcoin price predictions feel a little more plausible if it's the base asset for this new tokenized financial system. In the latest video from Crypto Rover, the host points out that the market is setting up for a big move, especially for Ethereum. Right now, a lot of traders are shorting the market, betting that prices will go down. This has created a massive pool of liquidity just above the current prices. The video suggests this is a perfect recipe for a short squeeze, where prices could shoot up fast to wipe out those short positions. For Bitcoin, there's a bullish divergence forming on the 1-hour chart, which often signals a price reversal to the upside. The host mentions that Bitcoin successfully filled a CME gap and is bouncing off a key support level. If that support fails, the next stop could be $150,000, but the overall bull market target remains $137,000. It's interesting to see the host's confidence in a short squeeze, especially with the data on institutional buying. The point about Sharpling Gaming's massive Ethereum accumulation is a solid one. It shows that big money is still very much interested in the space for the long term, not just for quick trades. This often gets lost in the day-to-day price chatter. The current market does feel a bit tense, with prices consolidating after a big run-up. The idea that a lot of traders are betting against the market sets up a classic contrarian play. If a positive catalyst appears, like more news on the spot Ether ETFs, it could easily trigger the kind of upward squeeze mentioned in the video. The market is definitely at a point where it could break out in either direction, but the buildup of short positions does make a move upward potentially more explosive. In the latest video from Lark Davis, he tackles a huge problem in crypto. It's not just about picking the right coin, but about sizing your positions correctly so you don't get wrecked. Many investors lose their savings by going too big on risky coins and panic selling during dips. The video points out that even massive asset managers like BlackRock are now suggesting a 1 to 2% Bitcoin allocation for traditional portfolios, a conservative approach designed for institutions. Lark Davis really hits on a point that gets lost in all the hype: discipline over Deegan-style gambling. The tiered approach he outlines is a very practical way to think about risk. What's interesting is how the conversation has changed. A few years ago, BlackRock suggesting even a 1% Bitcoin allocation would have been shocking. Now, with the launch of spot Bitcoin ETFs, it's becoming a standard talking point in mainstream finance. This makes the conservative approach much more accessible, while the aggressive strategies from Unchained remain for the high-conviction crowd. The video's focus on taking profits is also super important. The crypto community sometimes has a never sell mentality, but as we've seen time and again, turning paper gains into actual cash is the only way to win the game in the long run. In the latest video from the Ben Cowan channel, he shares his speculation on Bitcoin's next moves after it hit a new high of around $124,000 and then pulled back. While past Septembers have usually seen Bitcoin drop to its 20-week moving average, Cowan thinks the current price action looks a lot like the summer of 2020, not 2017 or 2021. He points out a strange coincidence. The peak in August 2020 was around $12,400, exactly 10 times less than the recent peak. Ben's theory about Ethereum leading the next short-term move before a market-wide correction feels pretty plausible right now. There's a lot of discussion centered on the potential impact of the upcoming spot Ethereum ETFs. The general idea is that a wave of new money could push ETH to new highs, which lines up with what Ben is saying. The ETH Bitcoin chart is something tons of traders are watching, and it does seem to be trying to build momentum. If Ethereum does get its moment, it could trigger a classic sell the news event or just general market exhaustion, leading to the September pullback he's predicting. It's a common pattern where one major asset has a big run, and then the whole market needs to cool off. In the latest video from the Coin Bureau channel, Guy unpacks Coinbase's Q2 earnings report to get a read on the health of the crypto market. While the headline numbers might seem a bit weak, the story underneath is more interesting. The video presents a solid, optimistic view based on the earnings report, especially concerning the new regulatory clarity in the US. It's true that having clearer rules is a huge plus for a company like Coinbase that wants to operate fully within the law. However, it feels like the ongoing legal battle with the SEC is a big elephant in the room that wasn't really touched on. That lawsuit still creates a lot of uncertainty. The report also makes it clear how much Coinbase still depends on trading fees. When the market is quiet, their main moneymaker slows down. Their efforts to build up other revenue sources like the Base blockchain and staking services seem absolutely necessary for their long-term stability. It really looks like their future success depends on two things: how well these non-trading businesses grow, and of course, the price of Bitcoin driving the next wave of market activity. In the latest video from Cryptosaurus, George tackles two big questions from his viewers about the current crypto market. The conversation kicks off with a theory about a massive Bitcoin supply squeeze happening by the end of 2026. George agrees, pointing out just how scarce Bitcoin is becoming. With ETFs already holding over 1 million coins, Michael Saylor close to 500,000, and an estimated 4 to 10 million coins lost forever, the available supply is shrinking fast. He believes this supply and demand problem will inevitably push Bitcoin's price way up, suggesting it will be well over $1 million in the coming years. For those wondering what to do with altcoin profits, he thinks moving them into Bitcoin is a smart play, especially as we get closer to what might be the cycle top. He also floats the idea that the old-school, multi-year crypto winners could be a thing of the past thanks to all the institutional buying. George brings up a fascinating point about whether or not crypto winters are a thing of the past. It's a popular idea this cycle. The logic that institutional money creates a higher price floor makes sense on the surface. However, it feels a bit too optimistic to think the cycles are completely gone. Institutional products like ETFs are two-way streets. While they bring in a flood of buying pressure on the way up, they can also create massive selling pressure on the way down if investor sentiment shifts. These big firms answer to their clients, and if clients panic, the funds have to sell. The broader economy still runs the show, and if we hit a rough patch, even institutional investors will pull back. The cycles might become less brutal than the 80% crashes we've seen before, but a long, cold crypto winter still seems very possible. In the latest video from the Crypto Banter channel, David from David Tech reveals his most profitable trading bot, the one he credits with making his own trading successful. He explains that you can get this bot and connect it to your exchange account completely free. The process involves heading over to the David Tech website and signing up for the 2-bit exchange using the provided links, which gives you a free account on his platform. The push to bring algorithmic trading to the average person is really picking up steam, and this video is a perfect example of it. The idea of using a pre-built, tested bot is incredibly appealing, especially for people who don't have the time to stare at charts all day. What's interesting is how the model works. It's a partnership between the strategy provider, David Tech, and an exchange, 2bit. This gives traders access to tools that used to be much more exclusive. However, a 50% win rate and a 24% drawdown mean you're going to experience some pretty significant downswings. The psychological challenge of letting a bot run during a losing streak is something that numbers on a screen don't fully capture. It's a shift from being a manual trader to being a systems manager, which is a different skill set altogether. In the latest video from Crypto Casey, she kicks things off by talking about Bitcoin's roller coaster week. It shot up to a new all-time high of over $123,000 before getting pushed back down to around $117,000. She sees this as a clear buy the dip moment, reminding everyone that we're in a bull market. According to her indicators, the bullish trend is safe as long as Bitcoin doesn't close the week below $14,000. It's fascinating to see the narrative around government and Bitcoin shifting so dramatically. What used to be a conversation filled with fear about bans and regulation is now centered on which country will accumulate the most. The idea of a U.S. strategic Bitcoin reserve, even if it starts with seized assets, is a massive psychological step. The debanking stories from people like the Trumps and Casey herself add a powerful, relatable angle to crypto's appeal. It's not just a speculative asset, but a necessary alternative when the traditional system can just decide to shut you out. The fight over stablecoin yields feels like the first real battleground where crypto directly challenges the banking sector's bread and butter. It's not just a tech issue anymore. It's becoming a political power struggle. In the latest video from Crypto Wendy, she talks about a project called Pinlink, $Pin, that's mixing together some of the hottest trends in crypto right now: real-world assets, RWA, decentralized physical infrastructure networks, DPIN, and AI. The idea is to let everyday people own a piece of real income-generating hardware. Pinlink has created a marketplace where you can buy tokenized fractions of things like high-performance Bitcoin miners. This means you don't need a ton of money to get started. For example, she mentions you can buy into a Bitcoin miner like the S19XP Hydro for just a few hundred USDC. She gives a powerful example. With $10,000, you could buy about 0.15 Bitcoin directly. But with Pinlink's model, that same $10,000 invested in their RWA mining fractions could potentially generate more than one whole Bitcoin over time. The platform also offers cheaper computing power for AI developers, creating a full ecosystem. Wendy notes that Pinlink is already making moves. They have an operational hydro-cooled mining facility in Saudi Arabia, and their shop for buying these tokenized assets is live. In fact, their first batch of fractional assets sold out by 83% very quickly. Looking ahead, they plan to launch their own decentralized exchange called Pinance for trading these assets and are integrating with other known projects like Pendle and the BitTensor ecosystem to expand their reach. It's interesting to see projects like Pinlink bundle the AI, DPN, and RWA narratives together. This is a very strong marketing approach because it taps into all the sectors that investors are most excited about right now. The real question will be in the execution. Offering fractionalized ownership of Bitcoin miners isn't a new concept, but integrating it with AI compute and a user-friendly marketplace could be what sets them apart. The fact that their initial offering saw an 83% sellout shows there's definite market appetite for this kind of product. The success of this will ultimately depend on whether the yield generated from their mining operations can consistently outperform simply buying and holding the underlying asset like Bitcoin. Their planned integrations with Pendle and BitTensor are smart moves, suggesting they're focused on building utility within the broader crypto world rather than just staying isolated. In the latest video from The Modern Investor, the host is stunned that a massive SEC rule change isn't getting more coverage. According to a recent SEC filing, any cryptocurrency that has at least 6 months of futures trading on an exchange like Coinbase derivatives platform can now qualify for an exchange-traded fund ETF. This is a huge shift from the old, dragged-out 240-day review process. It effectively kicks the door wide open for a whole bunch of altcoins to get their own ETFs. The excitement in this video is built on a very real development. The proposed rule change to fast-track ETFs for cryptos with established futures markets would absolutely change the game. It removes the arbitrary roadblocks the SEC has used for years and creates a clear, logical path for products beyond Bitcoin and Ethereum. It makes perfect sense that funds would be accumulating coins like Solana and Cardano in anticipation. The discussion about in-kind redemptions is also spot on. That's the real engine for integrating crypto into the financial machine, allowing for a circular economy where institutions can enter and exit positions without ever converting back to fiat. If these rules are fully adopted, it's not a matter of if a major altcoin season happens, but when.